What's up, tycoons? What's up, traders? Super excited for today's video. Lots and lots to talk about. I take my time very seriously, and I would never waste my time or your time. So, today's video is going to be jam-packed with useful information. We're going to do a slight analysis on the markets as well and take a look at the NASDAQ as well as TLT. But before we do that, there's lots of stuff that I think is really important that I want to share with you guys. So we're going to go ahead and go over all of that in today's video before we do some of the technical analysis. Now, if you're not familiar, I actually just launched a newsletter. It's a completely free newsletter. It's going over really relevant information in today's market regarding investing. And also, I'm including free trade ideas and setups in many of the newsletters. So if you guys are fans of, free valuable content and you are interested in some free trade ideas that you guys can potentially capitalize on, I highly recommend subscribing to the newsletter. There's a link in the description or a comment down below. Now, we take a look here, and Moody cuts its ratings of 10 U.S. banks and puts some big names on downgrade watch. And U.S. bank stocks declined after Moody's investor service lowered its ratings for 10 small and mid-sized lenders and said it may downgrade major firms, including U.S. Bancorp, Bank of New York Mellon Corp, State Street Corp, and Truist Financial Corp. So we got to talk about some of these bank stocks, right? Now, what's really a big reason behind this? And, we take a look at America's saving rate shame. Look at the savings rate for the biggest banks, guys. Chase, 0.01%. Bank of America, 0.01%. Wells Fargo, all right, exponentially above both of these, still at a 0.15%. Meanwhile, you guys can go out and get T-bills and get 4%, 5%, 6% yields on your cash now. And what this essentially means is that these banks, they're just taking all of that for profit, right? So, we won't go into, how the banking system works really and go deep into that. But essentially, you put your money in there and due to the way that the banking system is set up, they're essentially just taking your money, lending it out to others, investing it into T-bills, and getting a really, really big return on the money that you put inside of the banks. Now, Americans still have not made significant changes to financial behaviors. Okay. Only 5% of middle income Americans have changed banking providers as a result of the recent banking industry events. So, basically talking about the banking collapse, right? And by contrast, 32% have moved funds to high yield accounts to take advantage of higher interest rates. So we are seeing a small portion of people moving their accounts to high yield accounts, to take advantage of these higher interest rates. But overall, only 5% of middle income Americans changed banking providers really after the whole collapse with, Silicon Valley Bank and others. And 78% agree that their household was not affected by the recent banking failures, compared to only 9% who disagree. And 79% have not changed their financial behaviors despite recent banking failures, compared to only 7% who disagree. Now, Americans cite inflation as their primary financial challenge. Okay. When you look at the obstacles of financial prosperity, you see inflation overwhelming all of these right here. And the top concerns related to inflation, all right, it's a major concern for me as I pursue financial prosperity. It's affecting my current financial condition. All right. And also, both of these are up from Q1. I am unable to save as much as a result of inflation, and I have made significant cuts to my household spending to adjust for inflation. So, you're seeing the economy, you're seeing markets, you're seeing CNBC, people like this talk about inflation coming down. One thing people misunderstand and are a little bit ignorant to is inflation coming down does not mean prices are going down at all. Okay, that's definitely not what it means at all. Inflation going down means that the rate at which prices are rising is going up less. Okay, so if inflation, let's just say it goes from $100 in 2022, and then now whatever that was costs $105. If it only goes to up to $106 in 2023, inflation has come down at a dramatic pace, but prices are still getting higher, right? The consumer is not seeing those drops in prices. And Americans are leaving money on the table by not taking advantage of these higher yields on savings. Since early 2022, 68% of middle income Americans have not moved deposits into higher yielding accounts to take advantage of higher interest rates, despite concerns around inflation. Yet savers are interested in high yield accounts. 93% say that competitive rates are more important when choosing a banking provider, including 61% who say it is very important. Now, when asked what respondents would do with a $50,000 inheritance, saving it in a high yield savings account or CD ranks number 2. Now that's what's really interesting to me is people don't even know, you can go out here and you can invest in bonds right now. And I mean, you can get like 4% on long-term treasury bonds, right? Not even just the short-term ones. So, people are really not taking advantage of these higher yields. And digital access is more important than pricing and proximity. This is a reason essentially that people are not taking advantage of this, right? I mean, this is why they're going with Chase. I have a business account with Chase, and it's very easy, right? I mean, they're pretty much global. They're all over the US. There's ATMs, there's branches everywhere, and it's super easy, right? You can get 24/7 access via online or digital applications, which is a very important reason, okay, and factor to all generations, right? When you look at millennials, you look at Gen X, you look at the baby boomers, roughly 75% of them all include this as a very, very important reason and factor, as to why they're banking with the bank that they're banking with. Now, bank stocks have yet to rebound from the sell-off in March, right? You see the huge capitulation here in March, and bank stocks have, rallied, okay, but they really haven't rebounded overall from the massive sell-off, right? We're just above this high here in April. Okay. But still, the index level is trading around 90 right here, and it was up at 110 right before the collapse happened. Okay. Now, something else important, all right, is we've been seeing a surge in energy prices. Now, this suggests a high probability of recession. This is very important, right? And if you've been watching the videos, I'm long energy right now via Oxy, all right, and we can see that oil prices are, really, really just on a rapid rate of increase. And once they cross above this level here, you can see that oftentimes these gray shaded areas, a recession is very near term. It is close, coming close around the corner, right? Every single time we're at these levels. So it's a pretty significant level that we're at right now. And what this is this is a crude oil Brent, and then this is a percentage deviation from the trend. Okay, so you can see here that it's really on a rapid incline right now. And we're getting to these levels again where it says that a recession could be coming sometime soon. Now, the stock market has been dropping, all right, in the month of August. If you're not familiar with this chart, this is a really good chart. This is the August market performance, and taking into account the pre-election year seasonality data. And what you want to pay attention to here is all of the dotted lines. Okay, these are going to be all of the major indexes, according to pre-election years versus just the average performance in a non-pre-election year. And you can see that the first 8 trading days of August typically are not good for markets. That's when you start to see a strong pullback. And if seasonality was to play out, we pretty much just reached our 8th trading day of August. Remember, these are trading days, okay, not calendar days. And if this seasonality chart was to play out, it is very possible that we could start to see a rebound in the markets sometime soon. Now, that's not a guarantee. The market does not have to follow this chart precisely, but just a little bit of an idea. We've been expecting this type of sell-off coming into August, and we closed a lot of long positions in the Discord. And we've actually been capitalizing on put options, throughout various stocks and indexes as well. Now, one thing that I want to show you guys is, we talked a lot about the banks and stuff. Let's actually talk about the S&P 500. Now, what's really important here is when you take a look at their short-term debt and you take a look at their long-term debt, all right, it really does not look that bad. All right. And this is for the S&P 500. Another way to visualize this, if you look at their effective interest rate over time, it is in the 1.7 to 3.1% range as of Q2 2023. Now, what does this mean? Well, there's all these large interest rates, right? And it's grabbing a lot of people's attention. And if you're trying to go get a loan right now, a car loan, whatever type of loan, you're getting smacked with really, really high interest rates. But the effective interest rate for the S&P 500 is right in this 1.7 to 3.1% range. Now, how is this? Well, it's because in 2020, right? You can see here in 2020, you can see the dramatic shift down. What companies and corporations were doing was they were taking out excessive debt. And the reason being was because of the zero interest rate environment that we were in, that the Fed induced. And so, companies were essentially giving themselves a cushion. They're like, hey, while these rates are so low, we're going to take out actually more debt than we really need, just in case things change, right? Just in case the market environment changes. And that was actually a really smart business decision. You can see only recently has it actually started to move back upwards, right? Move back in a positive and in an upwards direction. But for such a long time, heading into 2022, companies were just having this free debt almost, right? And free money essentially. So they played that really smart, and that was definitely a smart decision, by a lot of the top companies, right? The S&P 500 essentially is the top companies in the world, if you believe that the US is the top country in the world. Now, we kind of took a look at this earlier, the short-term debt cap, and then the long-term debt to cap. And these are ex financials right here. And you can see it doesn't look too bad, right? You take a look, it's under 4% here. Now, the long-term debt doesn't look as good, but still, you've seen a rapid decline in this, right? Really for the past like 20, 30 years, it's just been on a steady incline. And then you can see throughout that 2020, 2021, 2022 period, this is when you've seen a rapid decline in this. Now, inflation has just started to tick up again. You can see the streak of monthly declines in year-over-year CPI is set to end at 12. So that's when we actually got the boost up. And you see the streaks of monthly declines in year-over-year CPI. We actually just went on a historic run of, monthly declines in the year-over-year CPI. And this is pretty big, okay? You may not be able to tell by what Jerome Powell is saying and how they're, keeping interest rates rising. But this is a really historic run right here. I mean, you take a look, this chart goes back all the way to 1930, and you can see that, this is an amazing decline in year-over-year CPI. All right. Now, what's one reason that decline is ended? Well, it's rising diesel prices. What we're looking at on this chart is the New York Harbor diesel, and then we have the US CPI year over year, and these two tend to follow each other, right? You can see the correlation is very similar on both of these, all right? And the blue line, the light blue line is going to be your CPI year over year, and we can see that we've had these Harbor diesel prices starting to rise. Now, we've been talking about this in the Discord. We've been talking about it on the channel. And I do think that, we recently just saw on Friday, the PPI report was not favorable. All right. And the market crashed. And we're starting to see potentially that the next few inflation reports could come in hotter than expected because of this rise in energy prices, right? That's something to consider. Now, if this is just a dead cat bounce on energy prices, we start to go down, that's what you're going to look for if you're worried about inflation. But if this continues to go up and you think that inflation is going to continue going up, that makes a lot of sense, right? If we're going to keep seeing diesel prices, if we're going to keep seeing energy prices rising, you have to think about the way the economy works. Everything is transported, right? Nothing is just like at a place, manufactured at a place, and then sold at the same exact place. It's all transported, right? And it's all distributed, whether it's globally, whether it's regionally, whether it's across the country. Everything basically comes off of a truck, a ship, or a plane. And these rises in energy prices are going to cause the transportation companies to essentially charge more money to all of the manufacturers and distributors. So now I want to bring your attention to S&P 500 years with a return of 20% or more. And the reason I'm bringing this up is because really I want to highlight the max drawdown, right? If you take a look at the drawdown on these, you can see that there's significant pullbacks in the market, especially on years where the return is above 20%. So this correction that we're seeing, there may be more room to the downside, but it's not uncommon for the stock market to fall 15%, even 29%. You see this multiple times where we have these really big corrections over 10%, and still the market finishes off extremely well, right? I mean, we had a 50% return in 1933 and the stock market fell 29%, right? You take a look over here as well, a 31% return and the stock market fell 17%, 30% return and the stock market fell 14%. These are the drawdowns, right? So these are the quote unquote crashes, the market crashes that are happening, while the market is actually having an amazing year and setting up for amazing returns on the year. Now, with that being said, we're actually going to head on over to TradingView and take a look at some charts real quick. Again, a quick mention of the newsletter, guys. I'm putting out articles and, sending these newsletters, and they have free trade ideas inside of them. We'll take a look, right? We can click on the latest one that went out, the commodities, breaking down what it is that we're looking at, going over some nice detailed analysis as well for all of these. So be sure to subscribe to that free newsletter, completely free to you guys. It really helps support me out. All right, we're going to go ahead and take a look at TNX here. This is our 10-year Treasury, and then we'll take a look at TLT. And sorry. And we see here, it looks like TNX still has some room to the upside to go to, all right? 4.227 and 4.330. Those are going to be some of the targets that I'm looking at here when it comes to the 10-year Treasury. And I do think it's very possible that we get to those, right? That's going to complete our wave 5 here, and then we would look for an ABC correction and then possibly even another 5-wave move to the upside afterwards, right? If we were to zoom out and really just take a look at the bigger picture here, all right, we basically got this massive 5-wave move up. We got an ABC correction here, and this 1 2 3 4 5 is our wave 1. Okay, just like this wave 1 was a 1 2 3 4 5, right? This essentially is our wave 1 of, possibly the next larger wave 5 up, which could take us up to about 4.8, all the way up to about 5.5. Now, that may seem extreme, all right, but, that's definitely a possibility we want to consider, and we're really in a different environment now, right, where rates are truly going to be higher for longer. And we're not just speaking of the, federal fund rate, right, the Fed fund rate. We're actually talking about Treasury yields. If we were to zoom out a little bit on the TNX and go to like a monthly chart, okay, you can see that we've had this very long-term secular downtrend. But when you take a look at historically relative to where rates are right now, rates have been very high in the past. And if we were just to simply throw on the fibs here and do a retracement from the highs to our lows, okay, you can see that there's lots of room for this thing to continue going upwards just to hit a 38.2% retracement. If we were to throw on the 23.6 right here, you can see we're just now getting to those levels. So we're basically at the minimum retracement right now, right, at 4.04. And, this thing could, potentially head up to 6.29. Now, am I predicting that's going to happen? No, just something I wanted to point out to you guys that, yes, interest rates have been on a massive rally, but I mean, just even take a look at where they were back in the 1960s, and they were at 3.855, and then they went up for literally decades, right? For like 2 whole decades. And then since the late 80s and mid 80s, we've really just been on an amazing decline. So while it may seem super aggressive to say that, interest rates could go back up to 5% or higher, when you look at historically, I mean, those aren't very extreme numbers, right? And it doesn't seem so far out of reach for that as a possible scenario if we were, again, to get a continuation of this 5-wave structure to the upside. We got our ABC, and then this 5-wave is our wave 1, 2, 3, 4, 5, take us up to those higher levels. So with that being said, we're going to actually take a look at TLT real quick, because TLT is bleeding massively, to say the least. Okay. Now, I'm pretty excited about TLT from a long-term perspective at these prices. Eventually, the Fed will start cutting rates, but the big question is when. So, if they don't cut rates anytime soon, or they don't start aggressively cutting rates in 2024, and it takes until 2025, then it may be very hard to get the type of returns that you're looking for in TLT. So, you have to keep an open mind, and you have to ask yourself, what is your time horizon? What is your investment theory? What is your investment thesis when trying to invest in something like, treasury bonds, especially something like TLT, the 20 plus year treasury bond ETF. When we just take a look at TNX and saw how it's very possible that the rates could still continue going higher. Now, there's no guarantees there, but so far in TLT, it's done a good job of holding above that 94.73 support level. All right. We were not able to fill our gap up we had here. You can see basically 3 days in a row, that gap fill actually acted as resistance, and we've actually pushed back down. There's lots of gaps up to fill, right? And these gaps are pretty relevant, right? A really good example was the gap down here to 95. And I've been waiting for this gap to fill. Okay, this gap was all the way from November of 2022. And here we are in August now of 2023. And the gap just now finally filled. So with that being said, we do have two bullish gaps up that are pretty close by at 99.52. And we have a third bullish gap up here to about 108. And then we have a fourth bullish gap up here to 111. Now, there's many, many more gaps up to fill on the chart, right? We have a gap up here to about 147. We have a gap right here to 138. But you have to ask yourself, are those going to be filling anytime soon? And the answer to that question is no, right? We're not anywhere close to those gaps. They're not too relevant at the moment. So these are the gaps that we're paying attention to. Now, the big question is, will we come down and retest the lows, right? We have the lows over here that we established in October. And we're almost made a complete round trip back to those lows. So if we break this 94.73 level, I definitely think it's very possible we could get a scenario that looks like this, where we come down, break, retest 94.73, and then we start to head down towards 92.30. So right now, that's pretty much what I'm looking at. I do have some long positions in TLT at the moment. And after grabbing a hedge up here, some put option contracts, I took profit on those. We had a nice little drop. Okay. And for now, basically just sitting on hands, waiting to see, what truly is going to happen with TLT. Is this going to retest the lows around 92? Is it going to break those lows and potentially head, further down into the 80s, right? I mean, I've had price targets here of 87.29 and 81.14, and that's going to be kind of like a worst case scenario, right? I mean, if Treasury yields really go on a massive, bullish cycle, that's going to cause the bond funds and the bond ETFs to really break down. And if we break 92.30, we flip that to resistance from support. I definitely think it's possible that we could come down to 87.29, and maybe even one day 81.14. Now, am I betting on that? Is that something that I think is a high case probability scenario? Not necessarily, but it's just something that I'll have to see how things progress in TLT and monitor that. Now, let's go ahead and take a look at the NASDAQ real quick, and we'll break down NDX. We'll zoom in here to a 1 hour time frame, give you guys kind of a breakdown, on some potential scenarios we could see this week. Okay. One thing that I'm looking at right now is going to be this inverse bump and run pattern that we have forming, indicated by this trend line and also this trend line here. These two trend lines indicate a potential reversal pattern known as an inverse bump and run. You look for a break of this trend line and then a rally up towards the top trend line. That also would fill the gap up that the NDX has, right? You can see that there's a gap up here, basically right to our level of 15,703 on the NASDAQ 100. On the so that's basically what I'm looking at right now. There's a slight bullish divergence forming on the RSI. This is your relative strength index, and this is going to give you guys some opportunities, right? And let me explain what I mean by opportunities there. Okay. It's going to translate a couple ways, right? There's two ways that I see this playing out. So first off, let me explain what bullish divergence is if you're not familiar, right? Take a look here, how we have lows, and then take a look here, how we have these higher lows, right? But if you look on the price action of the chart, you can see we actually have lows here, and then we have lower lows, right? So what we're getting is lows, lower lows, and then here we're getting lows, higher lows, right? So that's a simple term known as bullish divergence. It indicates you may see some type of bullish activity. So we have bullish divergence forming after really holding this strong level here of 14,980. You can see we reacted really well and buyer stepped in. Is this a dead cat bounce, and are we going to break through there and head down to 14,785? That's definitely a possibility, but let's go over some of these scenarios. So we'll just call this scenario number one is going to be the straight bullish one, where we get the bullish divergence and the inverse bump and run pattern to play out, and we come up and we get the gap fill here, all right, right around 15,703 on the NASDAQ. That's going to be your number one. Number two, okay, is going to be a scalping opportunity. So if we continue to bounce off of this trend line and we break this RSI trend line right here, that's going to be a scalp opportunity for an intraday trade, right? And you'll be able to, get some put option contracts, and just depending on where the price is and the levels that we're trading at currently, you'll look for a scalp opportunity to the next level to the downside, okay? Because oftentimes these divergence trend lines, they signify breakouts or breakdowns. And in this case, if we break through here, it would be a nice breakdown. And I don't think that would be a chance where you're looking to swing put options. At that point, at that opportunity, really, I would be looking for potential longs, because, the way you want to use the RSI in your oversold and overbought conditions is, the first time something enters oversold, as you see it did over here, we did get a small rally, but it hit resistance, right? And now, if we were to break this trend line, we'd be coming down into oversold territory again. And that's when things really start to get a little bit more overbought or oversold, is the second, third, fourth time that they enter into those conditions, right? I mean, a really good example is, take a look here when we are overbought. Yes, there's a small pullback, but if you're trying to swing put options because we simply went overbought on the NASDAQ 100, look at how bad you got murdered, right? And then we come up and we go even more overbought, and yes, we get a pullback here, but if you're trying to swing put options, you got murdered, right? And the thing is because this is indicating that we have lots of strength, right? This is indicating lots of strength here. Being that we're at these overbought conditions, that's all that is telling you, is that, hey, there's a lot of strength in the NASDAQ 100 right now. Maybe things ran up at a little bit too fast of a pace, and maybe it needs to consolidate sideways before its next move up. But you can see, after the third, fourth, fifth time that we get to those overbought conditions, that's when we really start to see the larger move down and the bigger leg down. So, if we come down here, we've already went one, two, almost three times to these oversold conditions. If we were to come back down again, that's when we could start to actually see the NASDAQ 100 really get more oversold. And then that's when we would be looking for a scenario that happened over here, where we went overbought 4 or 5 times. And then that was actually a swing opportunity. And you can see we had, a pretty significant drop of about, really hundreds and hundreds of points, right? We went from 15,935 all the way down to 15,386. All right. So, almost 600 point move there on the NASDAQ. And that was a good swing trade opportunity. If you're following and using the RSI correctly, as I'm explaining it. And so over here, that's when we're possibly going to be presented with that opportunity again. If we break this bullish divergence trend line and don't see any follow through and don't see this inverse bump and run play out, the inverse bump and run is still going to be valid as long as this trend line here is still there. So if we come down to lower levels, the structure is still going to be there, and we could just, break through the pattern at a much lower level around 14,785. We've also got some support here at 14,637, 14,510. Really just depends. So I'm going to go ahead and end the video there. Smash that like button, subscribe to the channel, check out the newsletter. There's a link in the description or in a comment down below, and I'm out.